Look at your 401k statement right now, or the last one you remember. Somewhere on it, in small print, is a number with a percent sign next to it. 0.5%. 1%. 1.5%. Most people skip right past it.
That number is an expense ratio, and it is the fee you pay every single year to hold your investments, whether the market goes up or down.
It does not show up as a withdrawal. Nothing gets deducted from your paycheck for it.
It just quietly shaves a sliver off your balance every year, for as long as you hold the account.
Here is what that sliver actually does.
According to the Department of Labor's own fee disclosure guide, a 1 percentage point difference in fees on the exact same savings over a working career can shrink your final balance by more than a quarter.
Not because the market did anything different. Just because of the fee. That is the whole video.
Let's make that concrete before we explain why it happens. The Department of Labor put out a plain illustration a while back, and it still holds up, because the math behind it does not change.
Start with $25,000 in a 401k. 35 years until retirement.
Assume the market returns 7% a year, before fees, which is a reasonable long-run average for a stock-heavy portfolio. At a fee of 0.5% a year, that $25,000 grows to roughly $227,000 by retirement. At a fee of 1.5%, same $25,000, same 7% market, same 35 years, it grows to about $163,000.
That is a $64,000 difference. A 28% smaller retirement account. From a 1 percentage point difference in a number most people have never looked up.
And this is not a rare, worst-case scenario. It is what a completely ordinary, completely legal 401k fee structure can do, silently, over a career.
You will not get a letter warning you. You have to go find the number yourself.
To be clear about scale, this is not a fringe issue affecting a handful of unlucky accounts.
Americans are putting real money into these plans every year.
According to Vanguard's most recent look at its own retirement plan data, the average employee now defers 7 6/10% of pay into a 401k, and with the average employer match added on top, the combined contribution rate hit a record 12 1/10% last year. That is a lot of ongoing contributions for a fee, compounding quietly in the background, to work against. So let's talk about where that fee number comes from, and why it is not the same for everyone.
First, the plain definition. An expense ratio is not a fee you pay out of your paycheck or your bank account.
It is a percentage taken directly out of the fund itself, out of the pool of money you and every other investor in that fund have put in. If a fund charges a 1% expense ratio, the fund's managers keep 1% of the fund's total assets over the course of a year, spread out daily, to cover their costs and their profit.
You never see a transaction for it. Your balance is simply reported net of it, after the fee is already gone. That is what makes it invisible in a way a bank fee is not. A $12 monthly account fee shows up as a line on a statement. An expense ratio never does.
It is baked into the fund's performance number itself, so a fund that returned 9% already had its fee subtracted before you saw that 9%.
You are paying it. You are just never shown the moment it happens.
And it does not matter whether your contributions are traditional, pre-tax, or Roth, after tax. That choice changes when you pay income tax on the money.
It does not change the expense ratio at all.
The fee is charged against the fund's assets either way, at the same percentage, so the fee mechanism in this video applies identically regardless of which type of 401k dollars you are looking at.
This part matters for trust, so let's be precise about it. Your plan is legally required to tell you this number.
Under a federal rule, Section 404(a)(5) of the retirement law known as ERISA, your plan administrator has to give you a disclosure, before you can even enroll, showing every investment option's expense ratio, both as a percentage and as a dollar amount per $1,000 invested. And at least once a quarter, they have to send you a statement of the actual dollar fees taken out of your account.
So this is not hidden in the sense of illegal or secret.
It is disclosed, in a document that almost nobody reads, because it looks like paperwork, not like money.
The fee is not concealed. It is just formatted to be ignored.
That is a very different problem, and it means the fix is not a lawsuit, it is 5 minutes with a document you already have the legal right to.
So why is one person's expense ratio 0.5% and another person's is 1.5%?
Mostly, it comes down to what kind of fund the money sits in, not which company runs the plan. Index funds, the kind that just track a market benchmark like the S&P 500, are cheap to run. Nobody is picking stocks. According to fund industry data, the average index mutual fund charged about 0.06% by the end of last year.
That is not a typo. Under 0.1%. Actively managed funds, the kind where a team is trying to beat the market by picking investments, cost more to run. Research and trading are not free.
The same data puts the average actively managed fund at around 0.6%, close to 10 times more than the index fund average.
Neither one is a scam.
You are paying for something real in both cases, either a team's judgment or the near total absence of one. But that gap, roughly 0.1% versus roughly 0.6%, before you even get into more expensive share classes or plans that layer on administrative costs, is most of where that fee number on your statement comes from.
Here is where a lot of finance content oversimplifies, and this channel would rather slow down than do that. There is no single average 401k fee.
The real research, from the Investment Company Institute, the fund industry's own research group, reports it 3 different ways, and they are all correct, they are just answering different questions. Looking at it plan by plan, the average total cost across 401k plans is around 0.8%. Looking at it person by person, weighting by how many participants are in each plan, it comes down to about 0.5%. Looking at it dollar by dollar, weighting by how much money is actually invested, because larger plans tend to negotiate lower costs, it is closer to 0.33%.
Why the spread?
Bigger plans, at bigger employers, have more bargaining power and tend to land in that lower, asset-weighted number. Smaller plans, and plans that default people into pricier fund options, tend to sit higher.
None of those 3 numbers is wrong.
They just describe different slices of the same system, which is exactly why you cannot assume your own number from a headline.
You have to look at your own plan's document.
There is one more layer worth understanding, because it explains a lot of the gap between that low, asset-weighted number and the higher, plan-weighted one.
Many mutual funds are not sold as a single product.
They are sold in multiple versions, called share classes, that all own the exact same underlying investments, the same stocks, the same bonds, run by the same managers, but charge different fees depending on which version you happen to be in. There is usually an institutional share class, reserved for large investors like big retirement plans, and a retail share class, aimed at individuals, that owns the identical portfolio for a noticeably higher price. Research from the Pew Charitable Trusts found the median retail share class charges about 1/3 of a percentage point more than the institutional share class of the same equity fund, which works out to roughly 37% higher fees for literally the same investment. For bond funds, that gap was even wider. Why would anyone be in the pricier version of an identical fund? Mostly plan design, not a personal choice. Smaller employers, or older plans that have not renegotiated their lineup, sometimes default participants into the retail share class simply because that is what was set up years ago, while a large, well-negotiated plan gets its participants into the institutional share class of the exact same fund automatically. You are not choosing the more expensive version. Your plan structure is choosing it for you, unless someone checks. It is worth saying plainly that this is not a fringe theory this channel is speculating about. Retirement plan fiduciaries have a legal duty, under the same ERISA law that requires the fee disclosures, to act in participants' best interest, which includes not needlessly leaving them in a more expensive share class of a fund when a cheaper share class of the identical fund is available to the plan. When that duty is not met, it becomes the basis of a real lawsuit. According to legal industry tracking of these cases, ERISA excessive fee lawsuits against plan fiduciaries rose by roughly 35% in 2024 to a near-record pace, and unnecessary use of higher-cost share classes, alongside excessive record-keeping fees, the separate administrative charge for running the plan itself, are among the most common claims. A federal appeals court reversed a lower court's dismissal of exactly this kind of share class claim that same year. None of this means your plan is doing anything wrong. It means the mechanism in this video is well documented enough, in real regulatory and legal terms, to not be this channel's opinion. Let's run one more version of this math ourselves, with numbers closer to an ordinary paycheck than the Department of Labor's lump sum example. This is a hypothetical, not a claim about anyone specific, and not a projection or a guarantee about what markets will actually do. Say someone contributes $500 a month for 30 years, and the market averages that same 7% a year before fees, which again, is a reasonable long-run assumption, not a promise. In a plan charging a low 0.3%, close to that asset-weighted average we just covered, those contributions grow to roughly $575,000. In a plan charging 1%, still a completely ordinary, unremarkable fee, while under the Department of Labor's 1.5% example, the same contributions grow to roughly $502,000. That is about $73,000 less. Not from investing differently. Not from contributing less. From a fee difference of 0.7%, held for 30 years, on money that was otherwise doing exactly the same thing. That is the compounding mechanism in one sentence. A fee is not a one-time cost. It is a permanent tax on every future year of growth that money would have earned, including growth on the money the fee already took. Now the part every finance video owes you, and most skip. Where does this not apply, and where should you be careful about how much weight to put on what you just heard? First, none of this is personalized advice, and it is not trying to be. This video is general information about how fees work, not a recommendation about what you, specifically, should do with your account. Whether a given fee is worth it depends on things a video cannot know: your plan's actual options, your timeline, your risk tolerance, whether your employer match makes the whole plan worth it regardless of the fee. General information, not personal advice. Second, the 7% return used in both examples is an assumption, not a promise. Markets do not move in a smooth line. Some years are down significantly. Some are up more than 7%. The math scales the same way at any assumed return, but the dollar figures you heard are illustrations of a mechanism, not a forecast of what your account will actually be worth. Third, a higher expense ratio is not automatically the wrong choice. Some actively managed funds, in some periods, in some categories, outperform their benchmark by more than their fee costs. That is not the common case, and most independent, long-run research finds most active funds underperform their index after fees over long periods, but most is not all, and a blanket rule that expensive always means bad would be its own kind of oversimplification. Fourth, this is specific to fee structure. It says nothing about whether you are contributing enough, whether your employer offers a match you might be leaving on the table, or how your account is allocated across stocks and bonds. Those are separate, arguably bigger questions, and a low fee on the wrong allocation for your timeline is still a real problem this video has not addressed. Fifth, the expense ratio is not the only fee in a 401k, and this video is focused on it specifically because it is the largest and most consistently overlooked piece, not because it is the whole picture. Record-keeping and administrative fees, the separate charge for running the plan itself, sit on top of it, and are sometimes paid by your employer, sometimes passed through to you, sometimes split. Your plan's fee disclosure covers both, and they are worth reading as two separate lines, not one. And finally, none of the litigation context you just heard means a lawsuit is the right response to a high fee, or that your specific plan is doing anything improper. It was included to establish that this is a real, regulated, occasionally contested mechanism with a documented legal history, not a dramatic claim invented for this video. So what can you actually go check, this week, with what you now know? Nothing here is a specific investment instruction. It is a short list of documents you are already legally entitled to. 1. Find your plan's fee disclosure. It is the document required under that ERISA rule we covered, and your plan administrator or your HR department can point you to it, often inside your account portal under something like fund information, investment options, or fee disclosure. It is usually a table, one row per investment option available in your plan, with columns for the fund's name, its category, its performance history, and, the one that matters here, its expense ratio, sometimes labeled gross expense ratio or total annual operating expenses. That is the column this entire video has been about. Look for the column, not just the fund names. 2. Write down the expense ratio of whatever fund your contributions are actually going into. Not the plan's average. Yours, specifically. If you are not sure which fund that is worth finding out on its own, because a surprising number of people are invested in a plan's default option without having chosen it deliberately.
3. Compare it to what an index option in the same plan costs, if one exists.
Many 401k plans offer at least one index fund alongside actively managed options. That comparison, the actual numbers side by side, is more useful than any average you hear in a video like this one.
4.
Check whether the fund you are in has a name that includes a share class marker, things like investor, Class A, Class R, or institutional printed next to the fund name. If your plan lists more than one share class of the same fund with different expense ratios, that is worth noticing on its own, and if you are unsure which class you are in, that is a specific, answerable question for your plan administrator.
5.
Look for the separate record-keeping or administrative fee line on the same disclosure, apart from any single fund's expense ratio. It is usually described in dollars, sometimes as a flat amount, sometimes as a percentage of your balance, and it is often paid partly or fully by your employer, which is also worth simply knowing.
6.
If you genuinely do not know whether your fee is reasonable for what it is doing, that is a fair question for a fee-only financial advisor, someone paid a flat rate by you, not a commission by a fund company, or for your plan's own administrator, who is required to answer it. That is not a sales pitch for a specific advisor or product. It is pointing you to the people whose job is to answer a question this video is not equipped to answer about your specific account. None of these 6 steps ask you to buy, sell, or move anything. They ask you to read a document you already have a legal right to and currently probably have not opened. So here is the number to remember, and it is worth saying plainly one more time. A 1 percentage point difference in fees, held over a multi-decade career, can be worth tens of thousands of dollars, sometimes more, in your final retirement balance.
Not because of a market call. Not because of some clever trade.
Just because of an arithmetic property of compounding, and a fee that is disclosed but rarely read. That number is not a scandal, and it is not a secret. Every piece of it, the disclosure rule, the industry's own fee data, the Department of Labor's own illustration, is public and has been for years.
The only thing standing between most people and that number is that it lives in a document formatted to be skipped.
This video does not know your plan, your fund, or your number, and it should not pretend to. What it can tell you is where to look, and that the 20 minutes it takes to look is worth more, on average, than almost anything else you could do with 20 minutes and your retirement account. This is general information, not personal financial advice, and nothing here was a recommendation to buy, sell, or move any investment. It is also worth sitting with why a number this consequential ended up this invisible in the first place. Nobody designed the disclosure document to be skipped on purpose. It is simply long, it arrives alongside a stack of other paperwork during enrollment, and a percentage sign next to a fund name does not look urgent the way a bill does.
The fee does the same job either way.
A number that never demands your attention still spends 35 years compounding against you if you never give it any. If explanations like this one are useful to you, the channel is called the Money Archive, and the whole idea is to build a library of these, plain mechanics, source numbers, no hype, that are still just as true 5 years from now. The fee in your 401k statement will still work the same way then that it does today, and so will the disclosure document that already discloses it.
That is what archive means here.
Not news that expires in a week, but a mechanism worth understanding once and remembering.
Go find your own number. That is the only step that actually matters.